I think we are live now.
Yes. Hi, good morning and welcome everyone. Thank you for joining in today for this interesting session on insuring Bharat. And particularly we'll be focusing, the topic of insurance towards people-led risk protection models focus on, mutual insurance. And we'll be going through what mutual insurance is and typically, how this can be actually a tool to ensure the next 500 million people in India, wherein there is an addressable market, there is a short need, but there is still a gap that exists, and how we can fill that gap as well. With me today as a moderator, we have Mr. Sanjay Jain. So I'll just take a minute to introduce Mr. Sanjay as well, and then ask him to introduce our panel members, Mr. Vijay Mahajan and Mr. Kumar Shelov as well. Sanjay is the Chief Innovation Officer at CIO, and he also leads efforts to create, promote, and encourage entrepreneurship in areas around digital technology. In this role, he leads efforts at Bharat Inclusion Initiative, primary initiative of CIO, to bring more people into the formal economy and workforce in India. Sanjay has also been a fellow with iSpirit. He has worked closely with India SAC, creating those APIs for and leading the digitization of various processes, enabling them to go paperless, cashless, and presenceless as well. Sanjay also chairs, technology committee for modular open source identity platform that helps users, organizations such as governments implement a digital foundational ID in a cost-effective way. As an education background, Sanjay has done his MS from University of California, Los Angeles, and BTech in Computer Science and Engineering from IIT Mumbai. So, and before I can hand it over to Sanjay to introduce our panel members today and focus more on, what typically mutual insurance is. If any of the audience have any questions, so I'll request to keep those questions in the Q&A section that is there, and post the end of the discussion, probably the panel members can take those questions one by one as well. Right. Thank you all for joining in, and I'll hand over to Sanjay as well. Thank you, Sanjay, to be here, and I'll hand it over to you to take the discussion forward.
Thanks, Shashi. So I want to start by thanking all of you for taking the time to be a part of this conversation. Before I start, I want to talk about a little bit about the Bharat Inclusion Initiative, and in particular the research fellowship program that we have. So Bharat Inclusion Initiative is an initiative run at CI.co to look at how we can bring about sustainable change at the bottom of the pyramid, how we can expand the services that are offered today and include everybody into these formal services. The program is supported, by generous donations from our donors, which includes JP Morgan, it includes the Omidyar Network, Dell Foundation, and the Open Society Foundation, as well as MetLife. And I want to, in particular, thank the Bill and Melinda Gates Foundation, which provides us with very specific support around evangelization and early stage research. As a part of this program, one of the things that we focus on is the idea that we need to have early stage research into the problems that people are facing, so that then we can work with entrepreneurs and others to find ways of addressing them. And the research is very much important to inform all of these. So the Bharat Inclusion Research Fellowship is a program where we identify novel use cases for enhancing financial inclusion and generating actionable knowledge on the needs, habits, and preferences of the financially underserved in India. In 2020, we awarded 8 of these fellowships, and they cover a range of focus areas around data ownership, gig workers, MISO and community-based insurance, MSME clusters, tech-based credit assessment, and so on. And this is becoming a very important way for us to look at how we can serve this community better. And I would advise any of those in the audience who might be interested in joining this program to eventually watch out for a call for applications and become a part of it. Now I want to introduce our two panelists. Vijay Mahajan is the founder of Basics Social Enterprise Group. They provide high quality financial services to the underserved across India. He's also the secretary and CEO of the Rajiv Gandhi Foundation. And in his former roles, he was the chairman of CGAP, which is the consultative group for the alleviation of poverty, which is housed at the World Bank. He founded Pradhan. He served on the Rangarajan Committee for Financial Inclusion, and he has been a key part of many of the financial sector reforms that we have seen. His many articles and papers have informed a lot of the debate around financial inclusion. He's an alumnus of the IIM Ahmedabad, IIT Delhi, and the Woodrow Wilson School of Public and International Affairs at Princeton. Shelab is an Ashoka Fellow. He's an impact entrepreneur who has been leading Uplift Mutuals. It's a one-of-a-kind community-based health insurance platform in India and has been operating for the last 10 years. He has led the setting up of mutual health microinsurance across urban, rural, and tribal geographies. And he's through a very specific model around build, operate, and transfer. They're spread across Maharashtra and Rajasthan and cover 350,000 lives and is growing. He's also authored various reports on insurance, financial inclusion, and women empowerment. So welcome both of you to the panel. It's a pleasure to have both of you here.
Thank you.
Okay. So, at the start, I want to sort of, many of our audience may not be completely aware of what mutual insurance is. And, perhaps I think, Vijay, you would want to help us understand better as to what it is and, what's the context in which such systems operate.
So Sanjay, not just insurance, but almost everything that we know today as being provided by incredibly sophisticated institutions, whether corporate or government. Almost everything began a few hundred years ago or a few millennia ago as mutual, because indeed the original human institution was the family and the clan and so on. And therefore, any need which an individual human being could not meet was then first tried to be met by the family and then by the clan, and then eventually as society grew, sophisticated institutions came up. Insurance, at least in the modern form, began in England and Europe, and all early insurance was mutual. It was, in fact, the first documented case of insurances of the widows of Scottish priests, which was established. And, because Scottish priests used to go work in the countryside in parishes and often died at the prime of their lives and left behind their wives and children. And so the first life insurance program was started for them. Generally, since communities were small in rural areas, they could, initially establish informal ways of helping each other. And when that informal way of helping each other sort of became either too frequent or it became beyond the reach of individual help possibilities, it led some thinkers to say, okay, why don't we set up a facility where some money is set aside by everybody, because we don't know in advance which adversity will hit whom. So let everybody contribute. And when there is a problem, out of that common fund, those who suffered will be supported. So that simple idea was the beginning of mutual insurance. Interestingly, it grew from there to very large. Some of the world's largest companies, insurance companies, are mutuals. In fact, OM stands for Old Mutual, even today. It's one of the world's largest insurance companies. Many others began because they were building societies, that is house loan societies, and then they also established mutuals. In other cases, trade unions of workers, because the trade union movement was quite strong in the 19th and early 20th century, and the trade unions of workers established cooperatives for credit and mutuals for insurance. Interestingly, after it starting in England and Europe, mutual insurance actually took solid root in North America. The US and Canada are big bastions of mutual insurance even today. I think there are about 400 companies even today in the US and Canada which provide mutual insurance. And there's a association called NAMIC, National Association of Mutual Insurance Corporations, or cooperatives, which is active as the industry association. So that's at the level of, you might say, the corporate structure. The main difference is that every policyholder is also a shareholder. Unlike a share capital based insurance company where the shareholder need not buy a single policy from that insurance company, and the policyholder need not buy shares of the company. So there's a complete disconnect between the sources of capital and the coverage, which is the corporate structure. The capital comes from capital providers, shareholders, and the users or buyers of the service are different. There can be some cross possibilities, but that's not the norm. So that's really broadly what is mutual insurance. Now, I just want to end by saying that in the US and not as much in Europe, but in the US and Canada, there has been a tendency to demutualize. That is to convert mutual insurance companies into stock-based companies and have IPOs and so on. And the reason for that is that as regulatory capital requirements kept growing and as these companies wanted to grow beyond their initial boundaries. In the US, insurance licenses are statewide, by the way. Till fairly recently, you could start an insurance company in the US, in Michigan, for example, for just $5 million. But as they started working across state boundaries, they needed multiple orders of magnitude of capital increase, and that was not possible through the mutual route. So they decided to demutualize. Now, the point is that is perhaps a valid strategy for a highly developed country with high insurance penetration. But for a developing country like India, where insurance penetration is low and where per capita incomes are still very low, and there's a large part of the population which is poverty, for us to say, no, we don't want mutuals, because see, in the West, they started as mutuals, but today they are now all corporatizing, is, I think, misunderstanding the evolutionary path. When there's this phrase called the latecomer's advantage, and in technology, you catch up because you came late. But technology embedded in an institutional framework is what I'm talking about. And it is, I think, incorrect. And in the Indian regulator has constantly taken this view that mutuals suffer from covariant risk, and therefore, mutuals are not appropriate for India. Look at the West. Well, we are today where the West's per capita income was in 1880 or something, So we need to re-examine this assumption. I'll stop there.
Shalabh, you want to add something to this? You've been in the space for a while now, and how do you explain to your customers when they're looking at mutual what it means?
That's a very nice way of putting it, Sanjay. I think what we do, there is this comparison with mutual outside India, but inherently we have been mutual societies. As Vijay Mahajan sir was talking about, our villages, our communities, though we have been divided by caste quite often, but we have been mutual by design. We today still help each other. So, I'll give you a simple example. We work in Dungarpur in Rajasthan, and there, we had the government schemes, we had insurance companies come in. And when we said, you could do this on your own just by the way you're doing your credit, they took it very naturally. Yes, there was some, making them understand risk management and how do you underwrite it, all that. But the principle at the core is same: self-help and helping each other. And I think that clicks very fast with communities that are pre-organized. So for me, a mutual is the most natural way to do insurance, and I have a problem with insurance first being for profit. Profit does happen, but it has to first talk about people. Insurance for me is a social protection tool. And if we go that way, I think, profits generated, all the communities that are in mutual right now, they're sitting on piles of reserves today. So in that sense, mutual is the simplest form of coming together and pooling your risks.
Yeah. Before I go ahead, when I was reading, the research paper that Shalabh put out, and I'm going to put a plug for it at the end of the session. I think that what struck me was that there is a transfer from, insurance is seen as a risk transfer mechanism. And while what mutual does is it makes it a risk sharing mechanism. And I think when you start to share, you also have behavior changes, which then encourage better behavior and hence lower costs. So in some sense, I think what mutuals end up doing is reducing health, like in Shalabh's example, where you looked at healthcare, that ends up being more towards preventive and helps reducing the healthcare cost burden at the bottom of the pyramid. So that also, I think, adds a layer which is useful. And now, actually, I think as everything is going digital, I wanted to add one more thought in there and then open up the question to both of you again, was that typically when we have seen things go digital, they take the previous form and then just digitize it. But then there's another way of saying, let's go back to basics and reimagine what it could be like, right? So in what I heard, I think from Vijay, was that the going to basics was actually in some sense going back to what the mutuals were and reimagining that in a digital world, because that's the world we're moving towards. And so, and that may probably get us more bang for the buck than just taking what was there and converting it to a digital world. So again, maybe this time I start with you, Shalabh.
I completely agree with that, Sanjay, because we have, in fact, as we were doing this study, we are also parallelly constructing a digital twin of the mutual model, and it has been extremely strenuous on us to reimagine and go back to the first principles. It's not just the way whatever we are doing offline, we just make it online. We have to really go back, and there is my partners, there is a back and forth with them, and trying to understand how can you create a community digitally rather than digitize a community. How do you create a community digitally? And I think the challenge that we seek is that today, as much as we are connected, we are also alone. How do we create a model where this, loneliness gets taken care of? Our economies are in a very transitioning phase, and how do you make sure that people from different walks, build a community together? I think that's the biggest challenge right now for digitizing a mutual. So apart from the fact that distribution and claims challenges that the typical insurance company are trying to solve, what we are looking at now is, can you really build digital communities, and not with the people who are 24/7 glued to Twitter. These are people who are gig economy workers, your Kamwali buys. How do you make them come to the digital space and create a community? I think that's the challenge we are looking into right now.
Vijay, what do you?
First of all, I want to go back to the point you made about risk sharing versus risks transfer. See, again, let's look at the difference between the two capital structures. First and foremost, we must remember that a vast majority of insurance company risk is And actually, if that doesn't happen, and if it eats into the capital, that is an unhealthy situation. But almost always, insurance company risk is covered out of the accumulated premium in the current account, as well as reserves which have been accumulated from the past, which again is basically nothing but the profit generated out of the past premiums. When an insurance company starts settling its claims, its current claims, out of a third category called its capital, then actually it's already in trouble. So in practice, both mutuals and stockholder insurance companies are actually only doing risk sharing.
Okay.
In theory, there may be a risk transfer, but it's basically risk sharing. But it is what can be called an inter-period risk transfer.
Okay.
So if you think of a situation where I'm insuring for multiple years, then if it's say in the first 5 years, I had no losses, no claims. So that basically added to the insurance company's benefit reserves.
Mhm.
And then in the 6th year, I had a claim. So then I drew out of the accumulated reserves. So it's actually an inter-period risk transfer, within the balance sheet of the insurance company. And that's equally true whether it's a mutual or a stock held company. But the place where Sanjay, risk transfer is actually very well practiced in the capital-based insurance companies is in reinsurance.
Okay.
See, mutuals are not as good at reinsurance as the normal insurance companies are. So what normal insurance companies do is they assume a lot of the smaller risks on their own balance sheet,
Mhm.
and then they insure away in some ways. They buy insurance for the larger risks, what are called the long tail claims, which are less frequent but of a higher magnitude. They basically insure it away to reinsurers. And as a result, reinsurers have to have much higher level of deep pockets and so forth. So over the years, what has happened is that a wonderful structure has been established where first within the company's balance sheet, interperiod adjustment happens. Very rarely is the company's stockholders' capital turned because most of it actually goes off to the reinsurer. And the greatest example of that is the COVID year. It's very interesting that virtually no insurance company, to the best of my knowledge, certainly not in India, has gone insolvent, despite the fact that there's been very high covariant risk. So, and the reason for that is that the risks have been transferred out of the balance sheets of the insurance companies to reinsurers, and indeed reinsurers in turn they also transfer it, to hedge funds and so forth. So there's a complex structure there. Now, so this was part one of your question or your comment. The thing about being native digital, born digital versus converting digital, I agree with you, and I was delighted when you used the phrase "we should go back to basics." That's one of the reasons why I named my company Basics. There are some incredible advantages of the internet and of the fact that all of us have access to it in the form of a mobile phone. I mean, right now 500 million Indians have it, and I think by 2025 it will be 1 billion Indians. So still, it won't be 100%, but it's fairly large,
Right.
And so you combine these two, having access to the World Wide Web and the internet in your pocket. Why should we use standard operating procedures and institutional structures of the 20th century or the 19th century when these things didn't exist? So we really need thinkers like this. I mean, Sanjay, I know the kind of work you've done in the geographical mapping work. In the early, you're one of the pioneers in what today we call Google Maps. It's its earlier versions.
Yeah.
So the kind of fundamental thinking that was done with respect to geospatial data, and then bringing it literally in the pocket of every Ola user and every Ola taxi driver, and with such ease, you know, I am of the generation where I had to write to Survey of India, Dehradun, to get topo sheets of areas where I was doing watershed development, and God help us if it fell in a restricted zone.
Right.
You know, so compared to that, there's been those dramatic improvements where I can just go to the same village and download satellite imagery and of any year that I want from Google Pro.
Correct.
So what I'm saying is that fundamental thinking needs to be done to enable mutuality as the basic principle of insurance, but to go back to what I said, with very significant possibilities of reinsurance outside the balance sheet of the mutual. If the regular insurance companies need reinsurance at a power of 10, then mutuals need it at a power of 100 because they have higher covariant risks.
Right.
You know, so we need actually serious reinsurance almost as a regulatory requirement for mutuals.
Very interesting. So Shalabh, this brings us to the question on digital and scalability, right? Because I think while the digital tech brings in a big element of scalability, even the business models will require it, right? And yet mutuals have a very community feeling to it. And so I want to sort of go back to your conversation around building a community digitally and how that plays into making it scalable.
I think, I would be too early to answer that question, Sanjay. We are just exploring that. But taking your point forward, I think, the TikToks, the Facebooks, the WhatsApp of the world have demonstrated that the community is possible. How limited, how varied, how colored is a question to be explored, but definitely you have seen communities built digitally. So you have influencers and the likes. The challenge is that mera gum mera or tera gum tera. If we can bring this together digitally, is where we would be able to actually demonstrate creating a community digitally. And I think the way going forward is, why I like mutuals over a commercial model is that we invest in risk reduction. As Mahajan sir was saying, that reducing the risk is the prima facie goal of a mutual, because the idea is not to pay more, the idea is to benefit more, and benefits will accrue when you actually invest in risk reduction. Now, is that the way a digital community can be formed? By reducing risks as a big chunk of, because everybody is talking about digital distribution. Now, paying a premium and collecting a claim fast is good, very good. It should happen because those have been the pain points. But you can only create a community when you actually connect to the pain point on a daily basis. And the problem with insurance is it's the only product where the sacrifice is immediate and the pleasure is unknown. And how do we create that into a product where everybody feels part of it? Because in physical communities, we keep meeting, every month we meet, there is sharing of data and all that happens. In digital communities, nobody has time. Your screen time is 15 seconds, 18 seconds. 8 apps are the ones, only 8 apps are viewed on your phone on a daily basis. So how do you create that kind of, I said, a resonance with the people who are coming digitally, that we are connecting to them, to their daily life issues. And I think that is a challenge and that is an opportunity. And that needs to be really funded, really taken through, because we have a huge country that really needs insurance. And insurance not just in health, in everything that creates livelihood, that creates easy life. So in that sense, I think we should not take the digital version lightly. If there is, because right now, governance, I'll give you some small example. We elect about one person per 3,000 people to be the representatives. Now, in some cases, we have failed because the representatives have not been good enough. digitally, we can allow everybody to vote, and we are testing that. So you can actually go for a direct democracy model, let's not get into the majority minority kind of argument, but you can actually create now a governance model where you can vote through your phone and become a part of a mutual. And I think that is extremely liberating for a mutual to think like that, because for us, going to a parliamentary model of mutual has its own risks.
I actually want to come to one of the points that you made in the report around the cheese, right? And I think I want to link this up to the conversation that you had, and also with the earlier experience around basics and the microfinance sector. The whole physical model, makes it very important that finance is an important part of your life, and both access to it and living up to your responsibilities in the community, and that becomes crystal clear to the participants, and it's almost they live it, right? And that's why these models are being successful. But then when you go to the digital world and you're in a consumption mode and it's an entertainment device that you have, right, then that does not translate as well. So you need to find that balance between the two, and which is why I think when you're looking at a report and the use of SHGs as an infrastructure to do it, I think brings a physical element to it. And I'm trying to correlate that with what you just said with the digital piece. And I don't know where the right balance is between these two. And perhaps Vijay, I want to ask you to opine first, then I'll come back to Shalabh, give him some time to think as well.
Yeah, so it's kind of, it really requires some basic thinking, but just to build on the point that Shalabh was making, one one of the reasons, by the way, why even the commercial insurance sector has not gone down market in India, has not penetrated in the lower than the next 500 million, is because actually the risk levels are such that they are not insurable at any reasonable cost. For example, the actuarial risk in agriculture in India on the whole is something like 12%. And this was a 10-year-old World Bank study. And since then, climate change probably has made it 15, 16%. Now, if that is the underlying actuarial risk, and even if you put 1/10 of that, say another 1.5% as administrative costs, then you're talking of a 16.5% premium just to break even. And obviously the insurance company, if it is run with capital, will require some return on capital. So you need an 18% premium on the whole to insure Indian agriculture totality. Who's going to pay that premium? Nobody. So what is the answer? And by the way, the same story for livestock, and the same story also for human health, except in certain small segments. So in all the three cases, the underlying actuarial risk percentages are such that nobody will pay the premium if it is to be fully paid by them. And which is why whenever these things come up, whether it is crop insurance or it is health insurance, the government subsidizes the premium significantly. It doesn't bring down the premium as a whole. All that is happening is that instead of paying it from your pocket, you first pay it to the government as taxes, and then the government pays it on your behalf, and you feel very good about it. But the fact is that's an inefficient way of doing it. So then, if that is so, what is the answer? The answer is we need pre-insurance risk reduction investments in these sectors. Certainly in case of agriculture, which I know much better than say human health, I think we need to invest in drought-proofing the nation through intensive watershed management. We need to invest in good varietal selection so that we can have seeds which are drought tolerant or flood tolerant in some locations. We need to invest in new agronomic practices which are different from the Green Revolution kind of practices. And all this will require, maybe an investment of about say 10-20,000 crores a year for about 5 years. All right. Once that is done, the actual risk of Indian agriculture will come down maybe from 15% to 8%. And then it becomes insurable at a reasonable cost. Now, in all of this, where does mutuality come in? Mutuality comes in because risk reduction is not something you do sitting in Delhi on a map, on a big plan. It requires very micro level planning and very involved community participation. When you're trying to do a good watershed development, or when you're trying to do herd immunity, build herd immunity. By the way, till COVID, I used to know the word herd immunity only with respect to livestock.
Right.
So, and if you're trying to do human health improvement through immunization, then, or safe drinking water, all of this requires work at the micro community level, which is best handled by mutuals and not by large institutions. So what Kumar said is that, if I can rephrase it, that the digitalness and the mutualness enables us to do a decentralized amelioration of the risk conditions, and thereby actually make ourselves more appropriate for insurance, whether after that it is commercial or mutual is a moot point. A lot of the issue is insurance ultimately doesn't reduce your risk. It only saves you, gives you some financial compensation. Risk reduction is the primary social task, and commercial insurance is not designed to do it as well as mutual is.
Sure.
I wanted to answer your question. I don't see a dichotomy between what we have said with the SHG Federation and the digital twin for two reasons. One, SHG federations are very close to the governance model that are required for mutuals. People pooling in the credit risk and savings risks together. You add a layer of insurance, health insurance or whatever insurance you want to do it. When we started in 2004, we used to take about 30 to 45 days to settle a claim, because community would come together, sit together, voice vote, claim was settled. Today, we are doing it in 2 hours through a mobile phone. So for me, the SHG model is the governance a priori, where you have already a governance system available over which you can, it's the lower hanging fruit, frankly, where you can put the digital part and make it extremely efficient. Because efficiencies are needed in insurance. If you claim is they call it moment of truth in insurance. And if you do it fast, and if your processes are fast enough, communities will get further entrenched in. And I can, cite again, going back to Dungar, because it's one of the most difficult products we did in our lifetime, was that, people stay in one hilltop and they meet only once a month. But when they meet, they share not just their credit issues, their savings issues, they share their personal issues. And that was when we realized, this is the format which we need to bring the mutual part in. Now, if I have to do it digitally, then maybe I can connect to 24 more hilltops than I'm connecting today, because 24 hilltops cannot come here. So in that sense, I see SHG as the existing governance model which can take up mutual very fast. But digitally, you have to get in this to even the SHG federations to make sure that it's efficient enough and it's low cost. The idea is to be low cost, because mutuals are constantly looking at how do we reduce our op cost. Because jo bhi benefit hoga sabko milega, and that I think is what I think we are trying to say within the SHG federations also. Because NRLM, if you look at NRLM, these SHG federations are across the state. If you look at one state, and if you want to create, small pools, and then you want to connect them with a larger pool, the way undivided Andhra Pradesh did with the what is that program? I forgot. A huge program where they had these mandals made out of SHG federations, and they have
IKP.
Yeah, IKP. So they still to date have mutual insurance for credit. They still run that. It is not officially declared, but it is there. And for me, the entire technology is just a enabler. It enables what you're doing already, do better. So as far as digital natives are concerned, I think The idea is that mutuals have been limited by their geography. Technology allows us to, cancel that and say, okay, if I am a guy who wants the same as you in Mumbai, I can also pool my risk together and let's come together. I think that is what I'm looking at, and that's very powerful.
So now we have some questions from the audience, and I'm just going to jump into those a little bit and then come back to a bit of the regulatory aspect soon. So I think Arun's asking about risk reduction through mutuals. And I think, Shalabh, you have a great example in there, and perhaps you can go into that.
I will give an example of what we do in Pune and Mumbai, and to some extent in Rajasthan. If you invest, health, typically hospitalization insurance is all, health insurance is all about hospitalization insurance. So you go to hospital, you pay something, you are either reimbursed or it's a cashless process. Now, when we saw what was happening, typically, there are three parties to it right now. You have the hospital, you have the insurer, and you have the insured. Three different parties. Everybody wants to make money out of it. Okay, because profit is the human nature. We want to have profits. When we looked at the way commercial model was going, you had very high claim ratios, you had premiums rising, and you had less and less people buying insurance. So we came from a very business point of view to look at how do we stop this. And when we actually went to the people, went to the women in the slums of Pune and Mumbai, they said, Shalabh, हम daily बीमार पड़ते हैं, उसका क्या? हम hospital में नहीं जाना चाहते. It was a very straightforward question asked to us कि जब हम बीमार पड़ेंगे तभी हमको फायदा होगा, यानी हमको स्वस्थ रहने में कोई फायदा नहीं है. And that was something that hit us very hard. And when we looked at where the problems are, it was access, it was information, it was pricing of care, it was not knowing as to what is happening to your patient, and it pretty scared people. And that's where we decided, let's put a doctor in the slums and start our OPDs. And that has, as in one of the reasons that we have survived. See, running a health insurance thing is not a easy task. It's far harder than doing credit. Because again, I said, you're not getting something out of it immediately. So by investing in an outpatient care service, by investing in an access, where we provide people the information as to where to go, we have created a chain of events where our claim frequency is far lower than what commercial insurance expects. And we are talking about people in slums where the frequency of disease is supposed to be higher. So, for a commercial model, it can range anywhere between 6 to 7 to 9%. Ours, after 10 years, I'll tell you this is after 10 years, is about 1.5%. But this is because on the fact that we provide OPD service as a main checkpoint to people to, first come there, make sure, because 8 out of 10 things can be taken care of at the OPD level. So mutuals, and we have invested in that. We got donor grants to invest in that because we could not price that in the premium firsthand. Now it is priced in the premium after some time, but that was an initial investment that needed to be made.
Then I have a question from Swapnil Kate, and this is for Vijay. The distribution of commercial insurance is a hindrance to penetration. And the question is, can embedded insurance help solve some of this? And the related question is, if you are doing embedded insurance, then how do you solve product innovation? How do you solve product innovation? Because if you're embedding insurance, then you can't really innovate as much on the product because you can't really customize it so much to the needs of that person. But that's the basic assumption.
So this term embedded insurance is being used as what? Is it embedded in what? So,
for example, when you take credit, you typically embed two kinds of insurance, right? One is like some kind of a life insurance to protect the loan. Right. Actually, you don't protect the person, but the loan. And so those kinds of products.
Okay. Yeah. So sort of those are like credit linked or other. Well, in a sense, those are really artifacts for the that particular service provider, in this case credit, to protect their portfolio rather than an insurance benefit for the user. So yeah, it is true that on the other hand, because it comes tied with the credit, so you can get very high, in fact 100% penetration till such time as the regulator stops it. So that was a dilemma. In fact, in basics, for example, we had a combination of both. We had credit linked insurance, which was part of the loan, and then we also had sort of optional insurance that people could buy for different things: life, health, livestock, and crop separately, weather based. And our own experience was that, I mean, at the peak we had 1.8 million borrowers, and both the husband and the wife of the borrower are covered. So we at the peak we had 3.6 million covered, naturally, lives covered under the credit linked insurance. But the voluntary insurance did not add up to more than 1 million. It was less than a third, and most of it was actually linked to things like crop and livestock rather than to life and health. So, there is no doubt that if you want to offer customized products, then the distribution, in fact, just the awareness building and the the soliciting process takes longer. And whereas embedded, it naturally is more automatic. So those are the trade-offs. But I think when you're sort of using the mutual methodology, and you did refer to the self-help group, Shalabh referred to the Andhra Pradesh program. And since that time, Shalabh, now it is truly a nationwide program. There are over a crore of self-help groups in the country. So through that, there's a possibility of offering insurance over and above the self-help group credit program. And at least in Andhra Pradesh and Telangana, there is an entity called Srinidhi, which offers fairly automated credit to self-help group members. The kind of thing that you're talking about, that within a few hours of application, they can get a loan disbursement while going through the due process of appraisal by the self-help group, and even in their case by the village organization. So I think using that social capital infrastructure, which is already there in the country, and not forgetting, by the way, the few lakh cooperatives that you mentioned. 6 lakh is a bit of a mythical figure. There are about 90,000 PACs, primary agriculture cooperatives, and there are about 20,000 dairy cooperatives. Out of those 90,000 PACs, on the authority of the NABARD chairman just a couple of months ago, at least 30,000 are in very good shape. That is, they are alive and kicking. And certainly those 20,000 dairy co-ops are in good shape. So even 50,000 is not bad. In a nation with just 6 lakh villages, that's like roughly one functioning co-op in every 10, 12 villages. And so you add to that the self-help group, which are much more numerous. We have the social infrastructure in the country. If it is used creatively, using a combination of technology such as Srinidhi has done, and with the regulator taking a proactive view. If you remember, the RBI till 2006 was actually very protective of opening bank accounts. It used to think it's a privilege. I remember having got into a tiff with an RBI executive director in a conference, because I said a day is going to come when there'll be more mobile phones than bank accounts. And over lunch, he told me, you should not talk like that. But it took only 9 months after that to happen. But then when the RBI flipped, thanks to the National Committee on Financial Inclusion, which was chaired by Dr. Rangarajan, I was also a member, and financial inclusion was adopted as a goal. You know, it took only 8 years before that, from there to Jandhan, you know, from 2008 to 2015, where now we have, nearly 45 crore bank accounts for poor people. So what I'm saying is that we need an activist regulator which doesn't do this as a favor, but which sees this as its primary job. You know, that if you are the insurance regulator of India or of Bharat and not insurance regulator of South Bombay or, South Delhi, then you better worry about what percentage of your population is covered by the service you say you regulate. Rather than worry about the health of the few entities who cover a small percentage of the population.
Correct.
So our regulators are actually have to be held accountable for inclusion. And by the way, when I was a member of the Raghuram Rajan Committee on Financial Sector Reform in 2008, this was my main contribution to that. And I must say, to Raghuram Rajan's credit, that after arguing on this for many sessions, and saying that the job of the financial sector is to ensure price stability and macroeconomic growth, he conceded the point that in developing countries, there has to be a third criterion, and it is what percentage of your citizens are included in the financial sector. Otherwise, you might as well rename all these institutions the Reserve Bank of South Bombay, na? भाई रिजर्व बैंक ऑफ इंडिया काय को बोलता अपने को, है ना? रिजर्व बैंक ऑफ इंडिया है तो इंडिया का पूरा इंडिया का बात करो ना, है ना? सेम थिंग इंश्योरेंस रेगुलेटरी डेवलपमेंट अथॉरिटी ऑफ इंडिया लगा रखा है, तो पूरा बात करो इंडिया का. 6% इंश्योरेंस पेनिट्रेशन करके बैठा हुआ है इतना साल से, हर साल वही रिपोर्ट छापते हैं. व्हाट्स द यूज, So we really need to hold our regulator not just accountable, but say, hey boss, there's India stack available to you right next door. There's technologies available right next door. From IRDA's head office to Srinidhi head office is exactly 10 kilometers, but both are in Hyderabad. Go and see it. Go and see how they're doing it. If it's possible to reach poor women in remote villages with credit, it's equally possible to reach them with mutual insurance. So I think we really have to get aggressive with the regulator and hold them accountable. I would even go to the extent, Shalabh, of saying that we should issue a citizens report on insurance in India every year.
Yes, we should.
Right?
We should.
And say, bhai, dekho, theek hai. You are covering some 6%. बहुत खुशी का बात है. उसका system का health ये है. बाकी 94% का हाल ये है. What are your answers for that?
Yeah.
And if you don't have answers, here are some solutions. Some in India, some abroad. What are your answers for not adopting them?
So actually, it's a question. There's a standalone microinsurance committee report that came out, and Anish Gulati is asking, is mutual the best suited option for that with lowered capital requirement? So I know Shalabh's answer.
Sorry, there's
a question by Anish Gulati saying, do you think mutual is best suited for the standalone microinsurance companies, particularly with the lowered capital requirement?
Yeah, so this is the new microinsurance companies that have been announced, right? Is that what Anish is
report has been announced but not implemented, right?
Yeah, that's right. So that's what he's referring to as standalone.
Right.
Right. Okay. Well, I see. It's a coincidence that when Mirai Chatterjee's study report had also talked about mutual insurance, she had suggested a 20 crore startup capital, and I think roughly that is what is being talked here also. I think the two are different ideas. The standalone microinsurance company emanates from IRDA's positive experience in microinsurance distribution, which happened since 2004-5, and they are actually global. I mean, India is a global leader in microinsurance distribution. So if we include microinsurance, then all the numbers that I was talking about, 6% and all that, they change dramatically. Then we. But the fact is that insurance is insurance naam ke vaste. It does not significantly cover the kind of risks that need to be covered. And if we want to cover the full range of risks that lower income households face to their health and to their livelihoods and to their lives, then we do need full-fledged insurance. And that would have to be provided by insurance entities. Within that, my preference, like Shalabh's, is that it should be mutuals for the poorer segments, And, for us, I mean, maybe Shalabh feels like that, but for me, mutual is not a religion. For me, it's a utilitarian argument. It's a functional. It minimizes transaction costs of claim settlement. It minimizes the costs of awareness building and soliciting, and using today's technology, I think it is quite possible to do it with very, very low transaction costs, and with the only caveat that I mentioned, that every mutual should be regulatorily required to buy reinsurance, because there is higher covariant risk in mutuals. So other than that, I would prefer that if the new standalone companies are all actually preferably started as mutuals with compulsory reinsurance of a significant part of their risk.
Yeah. And that actually, I think, to Shalabh, there's one more question here. We are actually almost at end of time, so I want to keep this as the last one. Is what are the specific areas reinsurers can contribute towards developing mutuals in India, and particularly in the current regulatory environment? So that is I think it segues well with what we just heard.
Yeah.
Great. So yeah, do you have any points to add to that, or should we just go for closing comments?
No, we should go ahead. Yeah.
Great. So perhaps Shalabh, you, then I'll ask Vijay.
There's this one comment by Sharik Bhai.
Yes.
Saying that scale and mutuality are mutually contradictory. So I agree with that. You can scarcely be mutual with somebody living in even 20 kilometers away. It has to be sort of significantly community based. But I think the combination of things like WhatsApp groups or equivalent, increases that circle to some extent. And then in any case, to me, the scale answer is scale question is answered by creating a mutual of mutuals.
Yes.
For the purpose of reinsurance, and even that mutual of mutuals then buys further reinsurance from a regular commercial reinsurance company. So the moment you create a mutual of mutuals, then you already sort of while retaining the principle of mutuality, you also retained immediacy, proximity of the immediate users, and you can therefore structure it in such a way that you get the best of both worlds. So,
great. Shalabh, any final thoughts on this?
No, just to add to what Vijay sir said, I think, and that's something that we are exploring, that if we build a digital solution to it, we still can scale without losing our proximity to members. I think that's the argument we are going ahead with it, because we have worked with different communities across geographies. We have seen how localized solutions need to be. And that's where I think the next chapter of where we are going from, taking this study forward, is that, looking at whatever is available, the digital communities that are being made, that there is a scope for building communities at scale. And They will have their own, localized issues maybe. But as Vijay sir said, you could have a mutual of mutuals, and the way the Andhra Pradesh model, talked about the federation, the mandal, and the Samakhya thing, you could do something very similar for the entire country. So technology does allow us that. So I'm pretty hopeful about that.
Great. So actually, it's been a very fascinating conversation, and the audience has also put in a lot of questions, which unfortunately we are not able to get to. And I also had a whole bunch of points I wanted to cover, which we are unable to get to. So perhaps, we should look at maybe some more medium like a blog or something to answer some of these questions and bring them out. And so I think we'll do that. But great, a very fascinating conversation. Very, we went, at different levels, and I think that added to the richness of the conversation. So I want to thank both of you for your time, the audience for their participation.
Thank you.
And, it's been a great pleasure. Thank you.
Thank you. Thank you,
Thank you
Sanjay.
so much.
Shashi, you want to come back in?
Somebody is asking how to connect with me. It's, my mail ID is Vijay Mahajan 54 at gmail.com.
Great.
Vijay Mahajan 54 at gmail.com. Thank you.
Great. Shashi, over to you. Shashi, you're on mute.
Yeah. All right. Thank you, Sanjay. Thanks, Shelab, and thanks, Vijay sir. It's been, again, reiterating what Sanjay was saying. It's an amazing conversation. And definitely, I think we should not leave this to one, but we'll see, how probably in future we can continue this into a series and probably, help out in the sector, and typically, encourage people to take this up, and, encourage also to the government and policymakers to take a step forward, and, how do you materialize these things also. But thanks for the conversation for today. And my colleague has also shared a link to the report that we were mentioning earlier as well, which was part of the BIRF Bharat Research Fellowship. Shelab was a part of it, along with Payal, and Professor Sharik as well. Yes. Thank you, and interesting to have you all guys over here, and it's been a great conversation. Thank you so much for joining in.
Thank you.
Thank you, everyone.
All right.
Thank you.
Thanks. Bye.